Hello, everybody. My name is Bruce Montgomery, and this is my colleague, Tracy Priest.
Hello, everybody.
And we're with The Road to Retail. On our podcast, Tracy and I hope to offer tips, insights, ideas, and examples for how small, emerging, and challenger CPG, consumer packaged goods, brands can build their business. Everything from determining if you're ready to grow, where to start, how to prove it online, how to go about securing distribution at a national retailer, driving your business with the end consumer, and how to go about finding an investor if that's important to you. The bottom line is, we would love to help you be successful by highlighting the many important factors that go into establishing and growing your brand.
Bruce and I have been working in CPG commercial operations for over 30 years, working on brands of all sizes. By commercial operations, we mean sales, marketing, trade marketing, new product development, broker and distributor management, new product development, brand M&A, and financing. As a part of our show, we bring our guests that are brand founders and leaders, agencies, Amazon specialists, sales agents, contract manufacturers, retailers, and investors to discuss their experiences and share their insights with the audience.
To keep up with the show, please subscribe to the Road to Retail podcast on Apple Podcasts, Spotify, or YouTube. Leave us a review and consider sharing the show with a friend or colleague that may benefit from the content. You can also check out our website to learn more at www.road2retail.com and follow The Road to Retail on LinkedIn. We would love to have you along for the ride. Today's show is sponsored by Retail and Response. You've heard it a million times on this podcast. It's not about getting your product on the retail shelf. It's about moving product off the shelf and hitting the retailer's sales velocity hurdles fast. Otherwise, they're going to begin the discontinuation process. Trust me. A slow sales start can be fatal to your brand. You need consumers coming in seeking your brand. You know, the one they heard about on radio or saw on TV. If you think radio or TV advertising is too expensive, you need to speak with our friends at Retail and Response. With over 30 years helping drive hundreds of millions of dollars of sales for their clients, Retail and Response can get your brand on radio and TV for pennies on the dollar. Check them out at retailandresponse.com. That's retailandresponse.com.
Hello, everybody, and welcome to the most recent episode of Road to Retail, where we talk to CPG thought leaders, insiders, and friends and colleagues. And so, Bruce, my friend, how are you today?
I'm fine, Tracy. Looking forward to today's show. How are you?
I'm doing fantastic. Looking forward to this as well. This is going to be great. So tell us a little bit about who we have today.
Today we're joined by Nick McCoy, who is the co-founder and managing director at Whipstitch Capital. They are an investment bank that does a lot of work in the emerging brand space. So Nick, welcome to the show and thank you for your time today.
Thank you. It's great to be here. I appreciate you having me on.
Oh, no, thank you. So Nick, as we dive in here, why don't you just tell the audience a little bit about your background and what led you to get to Whipstitch, and then we'll dive in with a little more specifics about what your current firm, does.
Sure. Well, my background has really been heavily transaction focused. Ever since I got out of business school in the mid 90s, I was doing kind of corporate M&A for billion-dollar companies, private equity, from an insurance company's balance sheet. Made my way into the tech IPO business, and then when that blew up, landed in a boutique. I was an associate at the time with my managing director, and I realized shortly afterward that tech just was not that interesting to me. I really enjoyed the kind of the challenge and the uncertainty around and the dynamism around consumer and the tangibility of the brands, and trying to figure out what is it the consumers want and what are they going to want in 5 years, 10 years. And so that's when I really started to look into, growing a consumer business within that boutique. And that's basically kind of when I transitioned that way. That was about 2003 or four. I think I went to my first Expo East in 2003 in Washington, D.C. And since then, I'm very focused around kind of, what are the data trends in the industry, and, how do we get as smart as we can on that so that we can do the best job we can with our clients and also pick the clients that are going to, be more transactable in the near term, since that is our business is advising people on transactions, and sharing that information and that knowledge with the public so that the industry can also grow better and founders can benefit from it.
That's awesome. I love that.
Great.
So, as we dig in here a little bit, Nick, tell us about what Whipstitch Capital does and how they play the role they play with small emerging brands, you know, position for sale, grow, and facilitate the transaction. So tell us a little bit about what you guys do.
Yeah, so we work with brands when they want to raise, generally speaking, $20 million or more in capital for growth or, liquidity for shareholders, or if they want to sell their company. We also do work with some larger companies in helping them on the buy side when they want to buy or invest in the brands. Um, and kind of what do we do along those lines? Well, even before we are engaged by companies, we usually have a fairly lengthy relationship where we, kind of coach from the sidelines in some ways. And, people will call us and say, hey, we're thinking about expanding our product line this way or that way, but we want to raise money in a year. What do you think we should do? We get kind of a lot of those questions as we build those relationships. But once people are signed up, it's going through that process of getting a company kind of ready to go to market, doing the marketing materials, the lengthy model, going out, calling investors and/or buyers if you're selling a company and kind of running that process.
That's great. So Nick, what trends are you seeing driving consumer behavior and therefore the revenue dollars into these brands? Basically, what's hot? What are you guys seeing as things cross your tables each week?
So there's kind of a lot going on with the consumer right now. We have seen that inflation has had an impact a couple years ago in particular on the consumer. So that's something that we are watching closely now is, are we in a period that we could see inflation come back or not? Because that is something that dampens kind of, premiumization and better for. But right now we are seeing better for expanding, very nicely. One of the things that we track is in spins, there is an index called NPI, which is the natural product index. It's about 10% of the store sales. And we compare that to total store. And over the last couple of years, that has been trending at about a 4 or 5% gain over total store. The historical average kind of pre-COVID was between 2.5% and 5%. So we're kind of in the upper end of, where
Mhm.
it is. I think there's a lot of things behind that. There's a lot of people going on GLP-1s and they're being, kind of coached and, in some ways forced if they want them to work to eat more protein, more nutrient density, more fiber within less calories. So that kind of forces a better for choice there. Just the visibility of the whole MAHA and, this kind of health span trend that was in kind of in existence even going in before, nobody even heard the word MAHA before. It's just getting consumers to talk more about, longevity. And you've got all of these wearables and, the Whoop and the Aura Ring and, all of these things and, online services so that you can figure out at a much greater depth proactively where you are health-wise and marker-wise, and track these things daily.
So Nick, to help some of the listeners out there like Bruce Montgomery, can you just tell us what MAHA is?
Omaha is Make America Healthy Again. It's essentially the movement of Robert Kennedy Jr. in
Got it.
Washington,
Yeah.
to take that initiative.
So, Nick,
Got it.
just
Got it.
a little follow-up question. So, better for you, what are some of the maybe grocery categories that are hot right now in the better? Is it beverage? Is it snacks? Is it entrees? What kind of, or is it all across the board? Just
So
curious.
it is really across the board, and it's funny because over the years people have asked me so many times, well, what's a good category to get into?
Yeah.
And yeah, there are certain categories which may have, less big companies that are buyers than others. But there is innovation to be had in every category out there, and we're seeing it. So it may be that there's a more higher protein alternative or a cleaner label alternative. You see these categories that have been kind of stagnant for a very long time, and you have a new entrant with a cleaner label, a product that's formulated differently, packaging that looks different, it appeals to a younger audience, and then all of a sudden they transform the category and they become a leader. It's I never like to mention specific brands, but I think the example that is worth talking about is like Rao's in pasta sauce. There was
Hmm.
not a $9 pasta sauce on the market before that. It was $2 or $3 a jar. And so you have somebody coming along with something that's premium and different, and it grows the entire category. It brings new people into it.
Yeah, that's great. Great insight. All right, Bruce. Oh, no, I'm up. Sorry, my bad. So you see a lot of brands come across your desk. So tell us a little bit about what you see and what you look for in a small emerging brand that tells you, hey, I want to invest some time in this. Maybe they're onto something. So what are you looking for?
So I think um, most founders and kind of the investment system or ecosystem that we have here is really geared around a company grows, it gets funded, and at some point in time, there's going to be an exit.
Hmm.
And over the last 2 decades, that exit from when I got in the industry has started from a point where if you got to 10 million in revenue, you would have large companies knocking at your door and actually buying you. And then over the course of the kind of 2010 to 2020 decade, kind of 10 became 100. And I would say in many cases now it's 150 or 200,
Wow.
just depending on category and yeah, profitability. And that's, kind of trailing net revenue. If you have 10 million of EBITDA, it doesn't matter, what your revenue is, as long as you're growing and it's, somewhat sustainable, you're going to get a lot of interest too. So when I'm looking at brands, it is how large a headroom can this brand have? And it's really hard to do when a brand is very young because it may have a great product that can be about 30 million in size, but then they can have extensions to that product that actually make the brand much larger. And so if you're looking at the brand name, if the brand name has an ingredient in it or something like that that's limiting, well, that's going to limit brand headroom. Or if
Hmm.
it's in, a category where they're going to have to actually step out of the category to do it, well, that's increased risk, right? If it's one thing if you're in the center of the store and you're in the condiment aisle and you can be on this side of the wall and that side of the wall, or if you're in the freezer, just about every kind of frozen brand will being, one door with whatever, handhelds, and then another one with
Hmm.
burritos and another one with, bites for appetizers or something, right? There's this kind of great, if you look at like Amy's and some of these brands that are very large in freezer, you can see how they, cross so many subcategories. But if you're, starting in dairy and then you're going to go to the center of store, so you're in a different place in the store with a different temperature state, that is really, really hard to execute. So kind of thinking about what practically a brand can do, how big can it get, and what is the kind of data behind that and the founder vision and the economics of it is the big starting point.
Yeah. So
That's
why do you think there's a trend? So you said, 10, 15 years ago, if you were 10 million, you had people looking your way and now it's 150. What do you think fuels that? Or what is fueling that?
Well, a couple things. First of all, the industry has just gotten much larger. Expo West was much smaller. When I first started going, a decent bit of the floor was actually yoga mats and barbells and
Yeah, I remember
things like
that.
that, right?
Yeah,
And you don't see that anymore. We've gone from whatever, probably 1,000 booths to well north of 3,000 now
yeah,
consistently.
yeah.
And if you look at just the dollar amount in I say better for, but really it's innovative and better for, specialty innovative better for all the areas where you see the, kind of rapid growing upstart brands, that's approaching, if not over at this point, half a trillion. And so these are much bigger numbers than they were 20 years ago. So the menu of available companies for sale is grown. In fact, if you look at Spins data, and we published this at Expo West, the number of independent companies that aren't family businesses, like family agriculture companies, think like Lettuce in a Box or something like that, available for sale, has gone from like, I think it was 55 to 71 over the last 2 years. And that's 100 million in spins. And when you start to overlay online data on top of that, you get north of 100 real quick.
Right.
And so as this kind of menu of available companies has grown, larger strategics aren't pressed to, all jump on the one company that happens to be over 10 million in sales that's accessible to add to their portfolio. And they're actually much, much more comfortable with 200 million than 10, even if it costs them, orders of magnitude more to buy it. because that's what they're really good at. They're good at managing large brands, and they're good at taking those brands, making them very efficient, and squeezing every bit of market share they can out of them.
Yeah.
Well, and the other thing it would seem, and correct me, Nick, here, is the bigger strategics, they need a bigger brand to move the needle. Otherwise, they're introducing, a lot of execution risk. And I'm not sure I want to be the guy going into the Unilever board saying, here's a $17 million brand we should talk about. That might be a really short meeting for Bruce.
Yeah. Yeah.
Well,
So
yeah,
go
for
ahead. I'm
years,
sorry.
for years they were doing that brand headroom analysis to justify, the 17 or 20 or 30 or $40 million brands that they can be, as they would really want, permanent brands, right? These are the brands that you see on the shelf. Many of these legacy brands that started between 1850 and 1970, and that's probably 80%, of those larger brands. Um, that's what they want. They want brands that will still be on the shelf in 100 years. And if you're a couple hundred million in revenue today, you've done a lot more to validate that than if you're at 40.
Yeah.
Right.
I
So
want, I wanted
go
to
ahead,
jump in here
Tracy.
too, Bruce. So you were talking about brands that can expand into other categories, and I just want to give an example. I think Siete brand that just sold not too long ago did a great job of. I started in chips, then I did cookies, then they did churros, then they did taco seasoning, but all under that same Hispanic food platform, but expanded into all kinds of things. I think they did a great job. So I think that's a good example of a brand that would really attract a lot of attention.
Yes, and actually they started in tortillas, grain-free tortillas.
That's
And
right.
chips, I think, was actually the expansion, the headroom expansion that really accelerated it.
Yeah.
Um, and I also think, you were talking about trends. I do think that the diversification of our population is something that is definitely
Hmm.
boosting it. And I think that it's boosting it faster than the numbers, would make people kind of think, because as households mix and as we become more of a melting pot, as you see more multiracial households, you see more kind of ethnic blending of food choices. And so we may be X percent, white and X percent, Hispanic or whatever as a country, but the actual, particularly as communities evolve and get more and more diverse, the grocery stores evolve and the exposure and availability of, more food choices rather than just, the traditional of what we saw in 1970 when we were 90% white as a country. I mean, go to South LA right now and go to some of the grocery stores there, and it's absolutely amazing what you can get compared to in suburban Boston.
Hmm.
Yeah, exactly.
So Nick, thinking about the overall M&A market conditions, why do you think we're suddenly going to see potentially a lot of action around acquisitions of these emerging brands when it's been a little quiet the last couple of years? And yeah, that there was the COVID phenomenon when kind of everyone kind of pulled the emergency brake and it took a little while to, get the engine running again. But what are your thoughts on what's going on right now with acquisitions?
Yeah, I mean, we had a dry spell from what mid 22 to 24 or so, and that was tough on a lot of people. We had interest rates go up, and that choked a lot of liquidity for private equity. We saw inflation hit, and we saw the consumers trending away from better for and premium. When that happened, they moved more to private label, and then we saw everybody going back to restaurants. It took a long time to kind of reverse that habit that happened in COVID. And that kind of perfect storm really hit consumer brand M&A more than other areas. Well, all that is kind of past us at this point, and we're seeing new funds and things like that closing, and we've also seen that a lot of the investments, when I'm talking about the 71 or 100 plus, depending on how you measure it, companies that are in private, a lot of which are in private equity portfolios or venture portfolios, it's more than half. These things all have a clock on them. And if you're at year 6 or 7 or 8 holding an investment, you're getting more and more motivated to do something with it. And that may be that you sell part of your stake and bring another fund in. It may be that you push that much harder for, a strategic sale. The other thing is when you look at those companies that this kind of, growing group of available for sale larger companies, on average, these are companies that are growing at about 2.5 to 3 times the store, and on average are about 2 times to 2.5 times the better for on the index. So if you actually look at kind of how are they classified by spins, there is a lot more of the NPI, or essentially the better for in these brands, which is, hot. So, here you've got a group of companies that have a clock on them, are growing faster than the store, so they're attractive, have attributes, sustainable, better for things that are intriguing to the buyers. You reach this kind of something's got to give place.
Hmm.
And if they don't get bought by big strategics, if I'm dead ass wrong here, right? And then I would say you're going to have this group of companies that gets even larger, more cash flowing, and you will start to see new strategic conglomerates form, like Sovos Brands, was done by Advent International before. You'll start to see more of those.
Mm,
Basically, new strategics, which will become buyers because something has
Interesting.
kind of got to give here. There's just too much attractiveness out there to be bought.
interesting. So, Nick, when you represent a client looking for an investment, whether that's either financial or strategic, what are they looking for in a target acquisition or investment?
So a number of things, and it depends a lot on stage, of course, but the brand headroom is a big one. Everybody wants to make sure that a company is going to get to uh, is going to be able to get to is a size that's going to be comfortable for a buyer, or is going to be able to get to a profitability level, at a smaller size, which will be attractive. Another thing that's really important today is looking at profitability. And this is something that before COVID was less important, but it's gotten much more important. So every brand is going to lose money on I shouldn't say every brand, but many brands are going to lose money as they grow. And that's okay, as long as those losses are essentially economic. If you spend $2 million to get $20 million of growth and your gross margin improves, that's wonderful. But there is definitely a fear of big burn out there. If you're particularly things like beverage and snacks, things where the growth can happen very quickly and the burn can be high as a result, there's a lot of, kind of deep dive diligence going into what is really kind of economic burn and what is systemic burn in a company. And the more the burn is economic, that's great. But the more it's systemic, the more resistance you're seeing, both on the strategic and the investor side.
Hmm. So,
Okay.
Nick, how important are things like patents or IP, or are those secondary to the conditions you just laid out?
I think it depends on the company. So many brands are so old that, they're running on trade secrets, right? I mean, the recipe of Coca-Cola and, things like that. And they're running on their brand equity. You can have all the IP in the world, but if you've got a brand like Coke, you can't create another Coke that's Coke. It's just never going to be Coke, right? People know the brand. Um, so I think in certain circumstances they're important, and it's important to be able to kind of patent, a process, maybe more in like supplements, but it is not as important as the differentiation and the ability of a brand to be appealing to a large audience, or a large enough audience to have high headroom.
Interesting. So on the flip side of Tracy's question, when a brand approaches you guys about, engaging you guys to help them transact, what do you tell them about the process and how do you manage their expectations? You already talked a little bit about kind of the revenue levels you should be at, but the information they're going to have to provide, the updates, the amount of time, let's assume a brand has come to you guys and you're interested. How do you say, Bruce, Tracy, here's how this is going to go. We're not going to put you up for sale on Monday, have 3 offers Wednesday, and close on Friday. How do you guys coach your potential and actual clients through this?
Yeah, it's a great question, and every process is different. There is a what I would almost call a cookie cutter investment banking sale process, which I think large banks have manuals that sit on the shelf somewhere with this in them, and it's 4 to 6 weeks to get materials together, and then you're basically going out and signing NDAs with potential buyers and giving them information, and you get a first bid. Basically it's an indication of interest. And then you qualify who's going to be coming in for management meetings. And then you have your kind of final bids, which is when everybody puts their best foot forward and you negotiate your price and a short exclusivity period and you close a deal. And that's, about a 6-month window. There's lots of reasons why that takes longer. There's usually much, much more information sought on a company than anybody can anticipate, because as people kind of dig into things, they will find other things to dig into. And you can manage that, and we do manage it, but at the same time, somebody has to get completely comfortable before they write a big check for your company. Um, and kind of the newer the brand and the faster growing, in some cases that means that they have to do, with the bigger team more rapidly, a deeper dive. Um,
When I'm sorry, Tracy, one final thing before I let you go. Nick, what percentage of founders, when they bring their brand to you, and let's say it's checking a lot of the boxes, it's big enough, it's growing, the unit level economics are good, they want to sell, but they also want to go forward. How do you coach them? Or do you say, look, Bruce, Tracy, if we hit your number, they might tell you, thanks for playing, stick around for 6 months in case we have questions, but we're buying it to fold it in, not to add to our overhead. How do you handle that?
well, it really starts with what you want to do as a seller. And if you as a seller, let's say that you owned 40% of your company. If your shareholders are tired and they want to get out and you want to take, 10% of your 40 and get liquidity on it, but you really want to go forward with your 30, that it doesn't sound too terrible to a lot of strategics. And, we are seeing more of those deals and financials too, for that matter.
Mhm.
Sometimes the brand is in a place where it's not quite large enough for a strategic, but you're going to get a tremendous amount of financial interest, based on the size and your ability to grow that brand further, and you will have a higher valuation and better terms, going with a financial partner. And especially if you're gonna roll 30%, you'll have a big outcome down the road. So it really starts with the seller's objectives.
Right. Okay. Sorry, Tracy.
No, no, you're all good. So, obviously, Nick, our audience is mostly small emerging brands. They're all trying to grow. So talk to our audience a little bit about what financing options are available for a small emerging brand looking to grow.
Well, the most appropriate financing for smaller brands is equity. I have seen people who have gotten into trouble, getting kind of too deep into debt before you can have the cash flow or the assets to sustain debt. If you
Right.
have your own manufacturing plant, you now have assets, so you can sustain debt based on those assets. But when you've got working capital of $1.5 million, or receivables and inventory that can get you $1.5 million of debt, and you somehow end up with five, and the interest payments become unwieldy, and you're kind of an awkward underwriting debt. It's just not it doesn't always end well. So getting that equity, it really is dependent on kind of the situation of each company and each founder. What we've found is the founders that kind of have the biggest team, and that doesn't mean the most employees, but that means the people who you've kind of networked with around the industry, or who are your advisors or board, earlier on, that kind of spreads that web and can draw more money in more easily. Because I think, we really can't help you in that three, four, or less financing, even if we wanted to. Forget the economics of it. You're really selling yourself. You're selling yourself more than your data. And yes, you're selling what you've done, but you've got to do that almost directly. That's almost a founder to investor sale every time. So the more that you kind of build that network and that team in within your company and within your advisor group, the better.
No, that's great. And given what you do, these are some of the questions that, Tracy and I get from lots of these emerging brands, and you live it every day. So, what sort of mental checklist should a small company run through when they're thinking about raising money or taking on an investor? What would indicate that they're even ready to try? Because to your point, we hear stories of I have three mortgages on my house, or my spouse just left me, these car crash scenarios. But we've had instances where people took on an investor and they're like, man, I had no idea that Nick would call me so often. I'm it's like, guys, they didn't give you money. They gave it to you, and they're expecting it back at some point, hopefully more than they gave you. So what's those two or three things where it's like, Bruce, if these things aren't working for you, you're not ready.
Well, I think one thing that's really important is the timing of the fundraise, particularly as you get to larger checks. And to do that, getting credit for kind of what you've done and timing for that. So if the reset date, for your category is March, And that means that, you're going to be on the shelf in September, or if the decision date is March and you're on the, shelf in September, well, you're going to be better off going out to raise money in, November, December, because you've got 3 months of data of all of your new placements. So, you're able to show people, hey, I've been on the shelf. My initial BOGO went by, and here's my new velocity level. And by the way, I've gone through a promo cycle since then, and you can see how I got lift afterward. Right? Those are the stories you want to tell. You want to get as much credit for kind of what you've done as possible. And that's at least 3 months of data on the other side. I think the other thing is kind of thinking bigger. And it's hard because you start a company and a lot of people start in their kitchen and their first round is a few 100,000 and getting to 4 or 5 million in sales is almost bigger than a lot of people were even thinking day one. It's hard to manage something like that. There's a reason why I don't, because I wouldn't be successful at it. Um, but being able to think of, okay, I want to raise 2 or 3 million because that's kind of easy. It sounds like a lower number, but the reality is you might want to raise 5 or 10 because the opportunity, is supports it. And actually having that much more money de-risks the whole deal, right? And you may have to take it in two checks, but you might have one investor that says, hey, we'll give you five now, and we're going to pre-commit to give you another five on these terms in the next 18 months. And that works too. So I think that's another thing that's important too, is kind of, again, understanding your headroom and that. A third thing is having a very clear vision of your brand, how it's different, what's kind of the onlyness, I love that word, of the brand. And then also what are the economics of it, right? As a founder, knowing what does it cost to make it, what are the individual components, and being able to very quickly on the top of your head show some mastery of that, so that as you're making strategic decisions and growing your brand, your investor has confidence that you're going to be doing it from a place of, of knowledge around profit.
So that's interesting. And folks, Nick just said a couple of things we've heard a lot of guests talk about. Early on, you're selling yourself and your vision, but you also have to perform. Differentiation, always key. Just because your four friends tell you your cookie is awesome at the farmer's market, that's not the robust data that Nick and folks like him are looking for, let alone a potential buyer. So, Nick, one last question about this process of raising money with smaller brands. And let's maybe not talk about these microscopic guys at 5 million. And believe me, I'm not belittling that. I have not started a $5 million company. But what kind of information will they need to have that's organized, not a shoebox full of receipts and like two PowerPoint charts folded up in their pocket? And what will they need to offer to attract an investor? Just what are the, you know, 4 years of audited financials and a couple of bank statements? Do they need distribution at two retailers people have heard of? What are those couple of things?
And you're talking about the kind of $5 to $10 million check size, or
Yeah,
what
yeah.
size?
So let's say maybe you're a $20 million brand. So you're not big enough yet to get Whipstitch to come work for you. But if a friend of yours called up and said, Nick, here's where I am. What are these people going to need me to show? And audited financials, some POs. I don't know. I'm interested in your views, not mine.
Yeah, yeah. Well, I mean, a $20 million brand can go and raise 20 million plus. Just depending on their growth and again, the headroom of the brand, the attractiveness, that may actually be an opportune time. But if you're talking about something that was, more of the kind of 5 or 10 raise size, you're starting to get to the point where you're dealing with more sophisticated investors there. So
Mm.
you are going to have financial statements that have, a reasonable level of gap applied. They don't have to be audited, but it's important to have at least had the discussion with your accountant of, is my trade spend actually gap the way I'm doing it? And the more that you can kind of do that right, the better. It's just number one, it just reflects better on you. It tells you, more about how your business actually runs profitably or not. But it also means that you're not going to get set up for a retrade by the investor after they've gone and done a quality of earnings, which a $10 million check writer might do. You definitely need, however many years of financials you have, up to four at least. historically, and in a projection model that's going to cover ideally 5 because that's the hold period most investors are underwriting to. Um, and again, it's that kind of clear vision. I think having more team members, especially when you're at a $10 million check, more team members than you that are showing up to those investor meetings so that they realize they're now investing more in a company and not just a founder and a brand.
Yeah. So folks, Nick said a couple of things there that are really interesting. We've heard on other episodes when he says a 5-year hold, that's kind of from the day they give you the money to the day they expect it back. And we talk about alignment of timing. Nick's investors probably don't want to invest in Bruce if my goal is to turn the company over to my children. That's not what they're investing for. So making sure you're aligned on the goals of the company and have some sense of timing. So that was really helpful, Nick. Thank you. Tracy?
Yep. So, Nick, tell us a little bit about your thoughts on what a brand or a company should look for in an investor. Should they look for just a guy that can write them a check, or somebody that's got some knowledge, obviously, or some experience in, raising money or been in the CPG industry? So, what's your thoughts on that? What's an ideal investor look like for a small and emerging brand?
It's a great question. So, I think the ideal is that they have somebody that is going to bring a playbook and an expertise that's complementary to their own, and also somebody that they really share kind of a vision with around the brand so that they have confidence that on the good days and the bad days, that the sentiment is going to be the same. And it's interesting because, founders kind of all around the spectrum of valuation oriented or partnership oriented. And, what we'll tell people is when you find the right partner and you have the right vision and you share it, valuation is going to take care of itself.
Hmm.
But, there are some entrepreneurs that want to call 200 venture firms and run a huge process to try to get the absolute best terms. And then you have others that, want to talk to 10 and they want to have 4 or 5 in-person meetings before they choose, which one that they want to work with. Um, and both approaches are valid, but I think that we do see those that have taken the time to really get to know and select and share vision with a partner, it tends to go a lot more smoothly.
Yeah, great
Interesting.
insight. We've been had a couple guests that have said that it's like a marriage.
Yeah.
Would you agree with that?
It's like a marriage, and I think as I said at BevNet one time on stage, it's a marriage you can't undo as easily as you can undo a marriage.
It's we've had investors, Nick. Some of them are like, I want to get to know Nick McCoy. I want to go just have lunch and talk and see if there's like any chemistry before we even start talking about his business. And we've had other investors that are like, I've heard 5 million stories. Send me your deck. I don't really care if I like you. I want to know if your business is viable. So we're heading toward home here, Nick. So in all of your experience with these emerging brands, are there any consistent moves that you see winners make? Or conversely, are there some consistent errors you see people make? And as soon as a brand makes it, you're like, oh boy, this is going to be a rough quarter. Why did they do that? What are the goods and bads you've seen that, if Bruce and Tracy do this, that kind of bodes well. It shows they know what they're doing, or at least they're extraordinarily lucky in the decisions they've made.
Yeah, it's a really good question because every brand is so different, every white space is so different, and the sentiment and the trends of the consumer are changing every day. So what won in 2015 would probably lose today. And you see companies that were kind of founded before their time and companies that were founded at just the right time, for what they're doing. I think one thing that the biggest winners do really well is they scale their investment with the essentially the success. So, there's people that will go out there and they'll get their first kind of package design and their first formula and they get some traction with a retailer and all of a sudden 5 retailers call them and they put their product in every single one of them, and raise the $2 million to pay all the slotting, which is getting increasingly expensive.
Oh
And
yeah.
and get it everywhere. And once it's kind of gotten out there, it doesn't do well. And when you look at successful products, almost every one of them is on version 4 or 5 or 6 or 7 of their package. And sometimes the formula changes, and whatever. There's like lots of changes there that happen. So you'd be better if you actually went to one conventional retailer that has enough geographic footprint that you've got a good idea on how am I going to do in conventional across the country. And a natural, like a Whole Foods or a Sprouts or somebody that's geographically spread, so you kind of know how you're going to do in that channel. And you've got online, right? So you're kind of placing your bets a little bit early in a smaller scale, and using the money you have, so you're conserving some. You're not spending as much until you realize you have the product that you can put $20 million behind, and grow it wildly, right? And get 70 or $80 million of growth out of it. A lot of
So,
times you'll see, and a lot of times you'll see people that will kind of raise to fund systemic burn, but not making the product pivot, not raising enough to make the product pivot to have the growth,
Hmm.
the growth, the economic burn kind of, that comes from that.
interesting. So, folks, again, Nick's reiterating a couple of the key points we've heard from some other guests. The importance of packaging, right?
Yep.
It's the one thing you can count on to be working for you all the time, whether that's presented in a digital environment or with a family walking down the aisle at the XYZ store. And, sometimes what works early isn't what's going to work down the road. Some people have a local artist design their package and it's very ornate and cool. And it works great at the farmer's market when your friends will interact with your package for 2 minutes. That's not how it's going to work in Publix. And then the other thing Nick said, and boy, Nick, it was great to hear you say it because Tracy and I, we've heard it a bunch of times and we counsel people as excited as you are to grow your baby, sometimes growing slow and working out all the kinks is the right play. If Walmart wants you in 3,000 stores, the right play might be 600. Can you keep up with demand? Are people finding your product on the shelf? Are you hitting velocity hurdles? And to your point about slotting, and for those of you that don't know, slotting is the price you pay to get on the shelf. And anyone who tells you they don't pay slotting is 99% lying. It's a profit center for the retailers. So to Nick's point, you don't want to blow $2 million on slotting and then find out your pricing's wrong or your packaging, no one can find it. So tempering, sometimes growing slow, it is the right way to go. Tracy, anything to add there or what's
No, I
next?
just want to reiterate, and we've talked a lot about it on our show. Slow and steady wins the race sometimes.
Mhm.
So that's great advice, Nick. So tell our audience a little bit about who's had the greatest influence on your career and why.
It's a great question, and I think I don't think I can point to one single person. I think I do a lot of work in the closing side of transactions, and so I interact with a lot of for lack of a better word, kind of deal people, on a daily basis, lawyers, investors, etc. And I still learn so much in every deal because you're always in a new situation that you haven't encountered before, and you're just drawing on, on kind of what you have internally, and all of your reps, as we call them internally, like lifting weight reps. Um, and so I've found over the years that there's a number of people I've interacted with, whether they're board members, investors that I keep up with, that are people that I will run a random question behind, and they will call me and do the same thing. It's almost like kind of a loose set of mentors through the industry, and I would say it's kind of that group in aggregate that I would say has probably helped the most.
I would call it a community. Would you call it a community?
I
Community,
would. I would say there's definitely this industry, the whole kind of branded food and beverage product industry, is a community.
yeah,
Yes.
for sure.
Well, I think you said a really interesting thing about the people you work with on the back end of these transactions when you're closing. I mean, certainly you've been at this a while and have had a lot of success, but when you say you're still learning a lot, I think that bodes well. And I think people have to always be learning. When you run into that person who thinks they know everything, that's who I want to bet against
Yes.
or compete. If you're standing still, you're easy to hit, man. All right, Nick, our final question. This one's very critical for national security. So, who is your favorite band, brand, or sports team, and why do you support them, or what do you find enjoyable about that?
Well, I'm embarrassed to say that I don't spend enough time following sports, even though I love to work out and play sports. And I don't really like to play favorites with brands. There's lots of
Probably
brands that I
wise in your
buy.
line of work.
What's
Yes.
that?
Probably wise in your line of work. Yeah.
But I will tell you, I do like, broadly speaking, indie rock and and kind of new music around that. I love finding new bands, and so I wouldn't say I have a favorite, but it's great if sometime in the last week or 2 weeks you found some new band that came to you on whatever a Spotify playlist or something out of the blue, and you're like, wow, these people are really good. So.
Well, that's great. And talk about a tough business to break into. We're wondering about getting better for you cookies. Try breaking in and becoming a brand with more than a band with more than like two songs.
I
That's got to
know.
be super hard. Well, Nick, you've been fantastic today. Tell the folks how they can get in touch with you or learn more about Whipstitch Capital, please.
Yeah, I mean, we obviously have our website, but my email is nick@whipstitchcapital.com, and Stitch has two T's, Stitch. Um, that's probably the best way to get me. And yeah, I really appreciate being here.
All right. Well, thank you again. Okay, Tracy, the big finish. I hope your
Yes.
arm is loose.
Yes, absolutely. Well, Nick, you've been great. Great insight. I think this is our small emerging audience is really just going to love your insight. And so continue, guys, to follow us on LinkedIn as well as Spotify and Apple. We do post every Tuesday. And also check us out on our website, www.road, the number two, retail.com. And thanks again, Nick, for joining us. We really appreciate it.
Thank you.
Good luck out there, folks.